Welcome to 𝗦𝗨𝗕𝗧𝗢, your premier destination for financial wisdom and real estate insights. Here, we unravel the intricacies of personal finance, real estate investment, and wealth management, empowering you with knowledge to make informed decisions. We delve into the depths of economic trends and financial strategies, demystifying the complex world of banking and investment. Our aim is to kindle your financial intellect, to help you navigate the choppy waters of economic uncertainty with confidence and finesse. We believe in the power of informed decision-making and in the potential of every individual to achieve financial independence. From tips on managing your personal finances to insights into the volatile world of real estate, 𝗦𝗨𝗕𝗧𝗢 is your go-to resource for all things finance. So buckle up as we embark on a journey of discovery and empowerment. Today, we delve into a topic that's sure to pique your curiosity: 5 money tricks banks don't want you to know. Money trick number 1, understanding interest rates. Interest rates. You've heard of them. You know they affect your savings and loans, but do you truly understand how they work? Let's dive in. Banks use interest rates to their advantage. That's how they make money. When you deposit money into a savings account, the bank pays you interest. But this is usually a tiny amount compared to the interest they charge when you borrow money from them. Now, there are 2 types of interest rates you need to know about: nominal and effective. The nominal interest rate is the basic rate that's advertised. It's what you see in bold letters when you walk into a bank or visit their website. But here's the trick. The nominal rate does not account for the effects of compounding. This is where the effective interest rate comes in. It considers compounding, which is when the interest you earn begins to earn interest itself. If your money is compounded annually, semi-annually, quarterly, or even monthly, the effective interest rate will be higher than the nominal rate. So why does this matter? Well, when you're saving money, a higher effective interest rate means more money in your pocket. But when you're borrowing money, a higher effective interest rate means you're paying more back to the bank. Understanding the difference between these 2 rates can help you make smarter financial decisions. For instance, when comparing savings accounts, look at the effective interest rate, not just the nominal one. And when comparing loans, remember that a low nominal rate might hide a high effective rate. The bottom line? Don't be fooled by the big, bold nominal interest rates that banks advertise. Look deeper. Understand the impact of compounding and the true cost or benefit of the interest rate. Understanding interest rates can be your first step towards financial empowerment. Money trick number 2, avoiding unnecessary fees. It's like a game of hide and seek that banks play with your money. They hide fees in the fine print and you have to seek them out. From account maintenance fees to ATM charges and overdraft penalties, these hidden costs can nibble away at your hard-earned money. Let's start with the maintenance fees. These are charges that banks impose for keeping your account open, often masked under the guise of service fees. They can range from a few dollars a month to over $20. Now imagine paying $20 every month for a whole year. That's a whopping $240 gone just like that. Next, we have ATM fees. If you've ever used an ATM outside of your bank's network, you've probably been hit with this one. It's like being charged for accessing your own money. These fees can be as high as $5 per transaction. If you make 2 out-of-network withdrawals per week, you're looking at an annual loss of over $500. And then there are the overdraft fees. This is when your bank allows a transaction to go through even if you don't have enough money in your account and then charges you for the privilege. This can cost up to $35 per transaction. So how do you avoid these fees? Be vigilant. Read the fine print before opening a bank account. Look for banks that offer no-fee accounts. Use your bank's ATM network whenever possible. And keep track of your balance to avoid overdrafts. Also, consider online banks. They often have lower fees because they don't have the overhead costs of traditional brick-and-mortar banks. In the end, it's your money. Don't let the banks play hide and seek with it. Be aware, be smart, and keep more of your money in your pocket. Remember, every penny saved is a penny earned. Money trick number 3, leverage online banking. In this digital age, traditional brick-and-mortar banks are quickly being overshadowed by their online counterparts. Why? Well, online banks have a lot to offer. Firstly, online banks typically offer higher interest rates on savings accounts. As they don't have the overhead costs of physical branches, they can pass those savings on to you, the customer. This means you can earn more on your savings just by choosing an online bank. Secondly, online banks often have lower fees. Again, the cost savings of not having physical branches allow online banks to charge less for their services. You might find that online banks don't charge monthly maintenance fees, or they may have lower overdraft fees. Furthermore, online banking offers unparalleled convenience. You can check your balance, transfer funds, and even deposit checks right from your smartphone. No more waiting in line at the bank or scrambling to get there before it closes. Of course, it's essential to ensure that any online bank you choose is FDIC insured, just like traditional banks, to make sure your money is safe. So take a moment to consider your banking options. Higher interest rates, lower fees, and the convenience of banking from anywhere at any time. What's not to love? In the digital age, online banking is your friend. Money trick number 4, use credit cards wisely. Now, we're not demonizing credit cards. In fact, they can be quite beneficial if used correctly. They can help you build credit, provide purchase protection, and offer rewards or cashback. But to harness these benefits, you must use credit cards wisely. Credit cards can quickly become a pitfall if you're not careful. The lure of buy now, pay later can be tempting, but it's a slippery slope. Interest rates on credit card debt can be incredibly high, leading you into a cycle of debt that's hard to escape. It's like a game of snake and ladder, where the snakes are all too eager to pull you down. However, this doesn't mean you should shy away from credit cards. It's about understanding how to use them to your advantage. One key strategy is to pay off your balance in full each month. This way, you're not charged interest and you avoid carrying over a balance. Think of your credit card as a short-term loan that you pay off each month. This way, you reap the benefits without falling into the debt trap. Another tip is to use your credit card for planned, budgeted-for purchases. This way, you're not spending beyond your means. And remember, credit card rewards are only beneficial if you're not carrying a balance. It's like getting a discount on a purchase, but if you're paying interest, that discount quickly evaporates. Lastly, don't forget to check your credit card statement regularly. Mistakes happen, and you don't want to pay for something you didn't purchase. Plus, it keeps you aware of your spending habits. To sum up, credit cards can offer several advantages, from building credit to earning rewards, but they can also lead to a cycle of debt if not used responsibly. So remember to pay off your balance in full each month, use your card for planned purchases, and regularly check your statements. Credit cards can be a tool, not a trap when used wisely. Money trick number 5, consider credit unions. This is a secret banks certainly don't want you to know. Credit unions are member-owned, not-for-profit financial cooperatives that exist to serve their members rather than to maximize corporate profits. Because they don't have shareholders demanding high returns, they can offer lower fees and better customer service. Imagine walking into a bank and everyone knows your name. That's the kind of personalized service you can expect from a credit union. And it's not just about the warm and fuzzy feeling. Credit unions often offer higher interest rates on savings accounts and lower interest rates on loan products. They are also known for their community involvement and financial literacy programs. In a world where big banks seem to hold all the cards, credit unions offer a refreshing alternative. If you're tired of feeling like a number, consider joining a credit union. Credit unions can be a great alternative to traditional banks. So there you have it, 5 money tricks banks don't want you to know. We've explored understanding interest rates, avoiding unnecessary fees, leveraging online banking, using credit cards wisely, and considering credit unions as viable alternatives. Each of these strategies can help you keep more of your hard-earned cash in your pocket. Remember to subscribe to 𝗦𝗨𝗕𝗦𝗖𝗥 for more financial wisdom and real estate insights. Until next time.